Hello everyone, my name is Deepak and I'm a tax code advisor. Today I have a very interesting subject matter I think almost all of us will appreciate. That is about taking distribution from our retirement accounts. So I was doing this call earlier with a client. He had saved up almost $4 million in his 401k account. So first of all, congratulations to this gentleman. Awesome job. And if you want to save up, $4 million, $5 million in your 401k plans, I have done financial freedom number calculations in other videos. You can go check that. I can put a link to that video as well. But he watched that video and he reached out to me and said, hey, Deepak, can you please help me figure out how much should I withdraw from my account? Because some people say I should be able to take 3% distribution, some say 4%, some say 5%. How do we figure that out? So it gets quite complicated because obviously we need to see the overall picture. We need to kind of strategize around everything. But one of the easiest one that we need to address before we move any further is the required minimum distribution. So those of you who don't know what that is that anytime you have a qualified retirement plan, such as 401k or maybe IRA account or something like that, you are required to take distribution from those accounts in your retirement years, whether you like it or not like it. What do I mean by that? Let's assume that you own a real estate which is producing rental income. Maybe you have a Roth 401k that is producing you tax-free income. Maybe you're able to access your life insurance policy for cash, and maybe you have some other savings. So maybe you don't need money in retirement. IRS says, I don't care. You save this money and we want you to take it out. And they tell us what formula to use to take that out. So I'm going to talk about that formula today, and then I'll talk about how should we plan for our distribution. So stay with me. I think you're going to find this video very insightful. I'm going to show you exact numbers. Now, those of you guys who are new to my channel, my name is Deepak and I'm a tax code advisor. I run a consulting firm known as Tax Code Advisors. So the way I work with my clients is I do a comprehensive call. It's usually 6 to 10 hours long. It takes about 3 to 4 days, and we look at your overall financial picture. We take a look at your mortgages. We take a look at the debt. We take a look at the tax planning, the education planning, the retirement planning, and we strategize around everything and come up with a game plan which will help you achieve your goals. And once you become a client, then you also get access to all kind of videos that I make on a regular basis to help my clients become better with their finances. So you get all of that for absolutely free, and all you got to do is become a client once. So once you have a client, you're good to go for the entire year. You're all set. Okay. So that's how it works. If you want to set up an appointment, talk to me. Go to taxcodeadvisors.com. I specialize obviously in taxes, but I own multiple businesses. I've built construction projects from scratch by buying the land and building the entire thing, and I invest in all kinds of things. So I got a thing or two that I can share with you. So whatever it is that you're doing, I might be able to help you out. So let's go back and let's figure out what is RMD. So RMD is required minimum distribution. The way RMD is calculated is we take a look at your balance. So let's say, for example, in this case, $4 million balance. And then we go to IRS and find out the life expectancy. So this person is a 70-year-old. So we'll go in IRS table, and IRS table will say, hey, somebody who's a 70-year-old, their life expectancy might be, let's say, 12 years or 15 years, whatever that number is. And based on that, they say, look, you need to take this money out because we need to get paid for our taxes. So let's just say, in this example, this person is $4 million net assets. And when I look at the IRS table, I think the number probably going to be close to about 27 or 28 years life expectancy. So what we are going to do is we are going to take $4 million and we're going to divide it by that 27.5, and we are going to get a number. And let me see if I have a calculator here. I can do that calculation real quick for you. So 4 million, 27.5, roughly about $146,000. That's what we need to take out for our RMD. So what I'm going to do here is I'm going to use that number. This is the exact number that I'm getting. So I'm going to use that number for my withdrawal rate. And you see every year from year 2, I'm changing that. And the reason being is because we want to increase it for inflation. So maybe I need more money, so I'm increasing it a little bit so you can kind of get an idea. So now one problem we have to deal with it. What is my tax going to be on that? Obviously, the tax is going to be based on how much, not how much I earn, but how much I withdraw from that account. So that's the key difference. More I withdraw, the more I'm responsible for taxes. With Roth, you get to pick and choose. With insurance, you get to pick and choose how much money you want to take out. But with your, 401ks and IRAs that you have not paid tax on, guess what? You don't have a choice. You have to take the money out, and that's where it gets tricky. So one of the question was, well, how do we calculate the tax? Well, nobody really knows what the tax is going to look like in future. So that's kind of hard to figure out. But what we can do is we can take a look at taxes today, and then based on that, we can come up with some idea. Well, in this case, this person is already 70. So this is a perfect example because we can use the current tax numbers, right? So let's take a look. Okay, so I have a table here. It says for merit filing jointly, for first $23,000 as of now, we pay 10%. From 23 to 94,000, we pay 12%. And from 94 to 201, we pay 22%. So if we take a look, that means this particular gentleman is going to be between 12 to 22%. Let's say he's an 18% tax bracket marginal rate. So that's the number I'm going to use here for my Excel sheet here. So this formula is already there. I'm going to put 18% in taxes. And then on top of that, depending upon which state you are in, I'm using 5%. Some people might have 10%. So I'll just use a 10% because I know a lot of you who are watching this from a high tax state, you're not surprised. But I want to show you this. So we withdraw $146,000 and look at my tax burden, $40,000. That's 1/3 of my income going in taxes. A lot of people do not understand this. Okay, this is a big problem. Now, if you come in age 70 and want to deal with it, there are some things I can do. But if you come a little bit earlier, if you're in your 50s and 60s and your 40s, I think we can do way better tax planning to deal with this problem, because this is a huge problem by the time we hit age 70. So I want you to make note of that. And because we are withdrawing more and more every single year, because I put that 3% inflation, my tax bill goes up. And I'm not even talking about other taxes, maybe capital gains and other income that I might have. I'm purely talking about just taxes from RMD. So just make a note of that. And don't worry, I'm going to do this calculation again for you for some couple of other examples if you want to know. And if you want to know specific for your case, then set up a consultation appointment. And because I want to understand the whole shebang, and then I'll tell you strategies how we can deal with this. How can we avoid most of this expense? Consultation appointments in 2024 at least is $1,500, and it comes with an entire plan. We look at everything, and then I tell you exactly specific steps that you can take to mitigate some of these problems. So $1,500 versus $40,000. I think it's a fair deal. All right. So let's talk a little bit more about this. So first of all, assumptions I'm making here is that this money that you have, $4 million, will continue to earn 10% on average. First of all, I know this is wrong. It does not earn 10% on average. Maybe on average it will be 7%, 8%. But because see what happens is when you hear the word averages out there, they are looking at it completely differently. They are just simply looking at an average return over some time. But what we're looking for is actual returns. So it's very hard to do this. So I don't really like using the 10% number. I'm more comfortable with maybe 7% for my calculations. That is just more fair. But honestly speaking, in your retirement years, even 7% can be quite risky because, what if you're not healthy? What if you have to travel? What if you have some emergency, you need to take care of something? All of a sudden, you should not be involved with managing your money at that point. I think in retirement, we are better off putting things on automated, putting things that are producing safer returns, something like a fixed income or maybe a bond or something like that. So I'm really more comfortable with, let's say, 5% number. Some of you might be even less, but I'm going to use the 5% number and see what happens when we use 5% number. So we start out with $4 million. I earn 5%. That means I'm earning $200,000. So far, life is good because I'm only withdrawing $146,000 and I have no impact whatsoever on my end result. The only problem is I only have $103,000 to be able to spend to buy stuff. Why? Because I have to pay that $40,000 in taxes. Now, another thing you need to figure out is what is the likelihood of mortality? Obviously, we're not going to die based on what IRS tells us. Each one of us have a different lifestyle. We have a different family. We work differently, so we have to kind of see what works for us. But let's just say if we at the age 90, how does the number look like? At age 90, based on this math, from $4 million, we are down to almost $2.5 million. And at this point, I am taking out almost $264,000 and I'm paying $72,000 a year in taxes. Okay, so still not bad. I still got almost 100,000. So you can see pretty much I kept your income, your buying power to be around the same. So you're not getting hit with that. And which is good. That means I still have money left over for my family, with these numbers. So if you're able to save 4 million, and we assume that 5% return, and you take almost $146,000, and then you add 3% inflation on top of that, I think the numbers look very, very nice. So numbers looks good, but these calculations we did are based on RMD. Now let's try to play around with numbers a little bit in a few other different directions. So one of the things we can do is I increase the tax rate to 20%. And what happens because nobody really knows in the future, right? So I put 25%, 5% state, 20% federal, but now take a look, how does my number look like if I'm earning 4% and I'm still taking that RMD, that number looks like this. If I'm earning 5%, you can see the numbers change slightly. If I'm able to earn aggressively, let's say 8%, now the numbers look like this. So I just want to show you things that are just so can change so much in retirement, and our age will be that we cannot cope up with all this stuff. Taxes is a big variable. How much you're going to earn, big variable. Anywhere between 3 to 8% probably be a reasonable number. So all of these things make a big difference. So let's just stick with our 5%. And now this is RMD, but what if you want to take more than RMD? Are we still going to be okay? So let's take a look. What if I want to take $200,000? So let's do that. So if we take a look, I don't really have anything left over, but at least until age 95, I'm still okay. So this is not bad, but I'm not really leaving any legacy. So this number kind of sucks, really. I need to earn more than 5% to really deal with that. What if I take a little less than my RMD? So remember that RMD is mandated by the government. Let's just say, it's kind of funny. What if we do 4% rule? So you might have heard of that 4% rule, right? All the time. So what if I take $160,000, for example? How does that look like? $160,000, I'm still okay. And that's why a lot of people use that 4% rule, because they assume that we're going to earn at least 5%. So with 4%, that's the numbers actually work out really, really good. So we can see at age 100, we still have $667,000. Okay, so number is still pretty good. What if I take less? Less than that. So not 4%. Maybe I take, let's say, 3%. Now I'm at 120,000, and numbers looks pretty good. You can see if I take 3%, I'm leaving quite a bit, almost $2 million in legacy, even though I have used up quite a bit for myself as well. So almost $90,000 in today's income for next 25 years, and still leaving almost $2 million in legacy. So pretty good bet there. So you can see there are a lot of different numbers, right? So inflation, what if we run into an inflation problem? I just want to show you an example. What if inflation is 4%? You know, then what happens? So now all of a sudden I need to withdraw more from my account to cope up with that inflation. So you can see out of $120,000, I'm taking a little bit more every year, 123, 127. So I increase that number a little bit. So now I don't have a $2 million. Now I have $1.4 million. So inflation plays a role. The federal taxes play a role. State taxes play a role. Your withdrawal rate plays a role. Your earnings rate plays a role. So there's just so many different variables to look at. So when I work with clients, I say, look, let's figure out maybe 2 or 3 scenarios that you think are most likely. And we run those numbers and we stick with the most conservative number possible. And that's how you plan for your future. But my biggest takeaway from these meetings is that let's deal with this tax problem here, because that's the one that's costing you a whole lot of money. So if we can deal with this problem, I think that's just amazing. So those of you guys who have not worked with me before, working with me is very simple process. We have 2 different ways. One is just a simple consultation call that's for a very specific tax matter. We can deal with it that way. The second one is a comprehensive consult, which is about 3 to 4 days. We talk about everything: retirement, the education, the kids, the side hustle, the business, the W-2 income, real estate income, foreign income, everything that's going on in your life. We take a look at it in a comprehensive way, and then I suggest you all kind of strategies that you want to implement. If you go with that, then all the training videos that I make on regular basis, you get access to all of that for free as well. So a great value for building wealth. So if you are a business owner, I think you will find the most value in it, because you want to really know all those things, because they're going to make a huge impact. All right. So once again, thank you so much for spending your time with me today. If there's anything I can do to help you, definitely leave your comments or reach out to me via taxcodeadvisors.com. Please do share the video with your friends, family members. I think they will like these numbers. If you want me to run the numbers for you specific matter, based on your savings, based on what you think, what you're going to earn, and so forth, then definitely I will be happy to help you out with that as well. So thank you so much, and I'll talk to you soon. Bye-bye.